if you are a business owner in Canada and you're concerned with either paying too much in taxes or having your small business tax deduction clawed back, then this is a video for you. This is the Commandments of Wealth podcast. I'm Alex.
I'm Joel.
And we are wealth managers from a wealth management firm based out of Toronto, Ontario, Canada. And we serve 6, 7, and 8-figure entrepreneurs and investors Canada-wide, coast to coast.
And we're going to go over some of the insights and strategies that we've implemented with clients to help preserve, protect, and grow their wealth and legacy for themselves, the next generation, and any charities or institutions that they want to pass that on to. And today we have an article that is right up that alley that goes over a specific insurance strategy on how you can protect your small business tax deduction and reduce your taxes to yourself and the estate while growing your wealth in a more tax efficient way. So with that said, I guess let's take a look at the article.
Sounds like a plan. So this article is titled Insurance Strategy for Retirement Income for Business Owners. And like you mentioned, Joel, absolutely. So this is a very big topic, very prevalent in the conversations that we have when it comes to talking with entrepreneurs.
Yeah.
And the reason is because back in 2018, the federal budget did some pretty significant and targeted changes to how income in businesses is treated. So what that's done is it's really gone after the traditional ways and methods and strategies that business owners were using to keep wealth within their corporations to benefit from that corporate tax structure and to minimize their taxes. So if we look here, what they're highlighting is that if you have a company in Canada, approximately 11 to 13% on average, right? From province to province. I know that this article is focused on Alberta, but we're talking to people Canada-wide, right? But it's very similar. So it's either 11% to 13%, depending. So Ontario's like 13%, right?
Ontario's 13%.
Yeah. So what happens is how it works is this. If you have $500,000 or less in active business income, then you're going to be getting a tax rate of about 11 to 13%. Right? I mean, for a lot of us, that's a lot better than what we pay on the personal side.
Listen,
right?
The smallest tax that you can be personally is 20%. This is a huge step up.
Yeah.
But the tax structure changes that Canada implemented through CRA, well, I guess you're going to talk about it, right?
Yeah.
Grinds us down.
Yeah.
So it becomes less effective without the proper strategy to grow wealth in the corporation like you used to be able to.
Exactly. So what are we talking about? So what we're talking about is you have $500,000 of active business, in revenue that you're able to generate at the 11%. Now, if you make passive income, they're treating that differently than active. So what is passive income? Passive income is dividends, right? That could come to you through the form of maybe investments that your company's holding. Income. So for example, if you have rental properties, real estate, things like that, that's bringing you money. Royalties, right? Those, are things that the government is deeming passive income. And what that does is they're giving you a $50,000 buffer of passive income that you're allowed to generate in your business for every $1 in excess of that $50,000.
Yeah.
They're going to claw back $5 of that small business tax deduction. So you might be thinking, well, I mean, $500,000 of active, active income. No, active income that they're giving, right? For the article.
Yeah.
So $500,000, like that might sound like a big number, but if for every $1 in excess of 50,000, they're taking $5 from you. That means that if you just had $150,000 of rental income, which is considered passive, you have zero small business deductions. So you only made, if that was like, let's just say that was the only source of income for your business. So your business only brought in 150,000, but because it was passive, you're now going to be subject to 23%.
So your tax bracket goes from 11, 13 to now that higher number, 23 to 26. It doubles.
Yeah. Which is, not very nice.
And I know there's a table there that kind of illustrates that, right?
Yeah, no, certainly. Exactly. So again, if you were to make 50,000, which is the allotment, right? So there's no change to your small business tax deduction. So there's no additional tax. If you were to make $100,000 in passive income, then that would grind you down to about $250,000 of small business deduction room, which would mean that you're looking at approximately $30,000 in taxes. And then lastly, if you did $150,000 of passive income, that would take the entire amount away, and you could be potentially looking at $60,000 in taxes. So you can see that that's huge. I mean, jumping from 11 to 23, that's more than double.
It's a pervasive problem. And I know in Canada, like we had a potential client recently that came knocking on our door. Similar situation, right? They had multiple properties that they had accumulated inside their corporation over the last decade and change. And up until this point, they're able to write off a lot of that income through mortgage expenses, renovations, interest income, all this stuff.
Yeah.
But now they're basically debt free on these properties and they're pumping out a lot of income, which actually started to claw back their small business deduction.
Yeah.
And so we started looking at different vehicles on what we can do about this. And a solution is one thing that we started implementing for all new monies. They talk about it in this article, right?
Absolutely. So to what your point is, it's the use of permanent life insurance. So what we're taking advantage of is that there's a CRA rule that stipulates that as long as the business is using after-tax dollars to pay for the premium of the insurance.
So it's an insurance rule. It's a CRA insurance rule.
It's a CRA insurance rule, exactly. So as long as they're using after-tax dollars to pay the cost of insurance known as premium, then any monies that's in that policy, in the cash value or the investment portion of it, it will be able to grow tax deferred.
So just like an RSP.
Yeah, just like an RSP, just similar to a TFSA. So what that means to your business is that it's in a form that the CRA deems acceptable. So it's not considered passive income. It's not going to generate any distributions that would be considered passive, which would grind down your small business tax.
So you get to keep your small business tax deduction.
Yes.
You're getting a permanent policy, which if you choose the investment component of some of these permanent policies, you're able to grow your capital in the same type of investment structure as an RSP or TFSA. So that means your dollar is not getting its legs cut off when it's compounding at a more efficient rate.
Yep.
And then at the same time, the beauty of this type of structure and using insurance is you're going to be able to pass on the assets of the corporation and within it to your beneficiaries in a more tax efficient manner.
Exactly. So, and again, one of the wise wealth management principles is that, look, you want your individual dollar to be doing as many jobs as possible, right?
Yeah.
So again, if you do things in the traditional way where you just have a dollar sitting in your corporation because you don't want to give it to yourself personally and pay taxes on it, right?
Yeah.
That dollar is only doing one thing. Maybe it's not even gaining interest because you're concerned that, well, if I even have interest, that's a form of income.
It's just looking up to the sky, collecting dust in the corporate account.
Yeah, because at least the government doesn't tax dust yet, right? Whereas with this, you can take that same monies, put that in an insurance vehicle, right? A particular insurance vehicle, and then have it grow, at a competitive rate.
Yeah.
Not have the benefit of that growth take away from your small business deduction, which is huge. Also, it's not going to be taxed while it's growing, period. Right?
As much.
No, it's in the insurance vehicle. It's not going to, it's deferred, right?
It's deferred.
Yeah, so because it's deferred, while it's growing, it's not, having that tax drag on it. So it's going to grow a lot faster than it would have otherwise.
It's going to compound quicker.
It's going to compound quicker. And then, at the end, when you turn into an angel,
you should have a bigger lump sum.
You're going to have a much bigger lump sum than you would have had if you were paying tax, over time on it.
Yeah.
And it can then transfer tax efficiently to the beneficiaries that you want the money to go to.
Yeah.
Right? And you know what? I'll even say, as an added bonus to all of what we just said, you can borrow against the value of that policy. So that equity portion in that policy, that cash value, when it hits, 200,000, $250,000, $500,000, right, or more, you can actually borrow, because what happens is the loan is not considered a taxable event, right? So
it's not income.
It's not considered income.
It's a collateralized debt.
Exactly, right? And that opens up other potential tax advantageous opportunities for the business owner, because again, if you're using the proceeds of that loan to pay for something related to business or investment, then you can also speak with your accountant and look at potentially writing off some of the interest payments that you're making to that loan. So all of these amazing benefits, right? So with that being said,
so just to recap,
I just want to recap very quickly. Okay.
So small business tax deduction does not get ground down.
That's correct.
Your money is going to be able to grow faster and compound because it's not having its legs chopped off every year from taxes.
Yes.
This is simply a CRA rule.
Mm-hmm.
The third thing is that it's going to leave a bigger portion for you down the line. And then you're going to be able to pass on the assets, the business and whatever is in it, in a more tax efficient manner than if you didn't have this structure.
Absolutely.
Can I buy this right now?
Yes, you can. Come talk to me afterwards. Come talk to me afterwards.
So this sounds amazing. What I'm getting at it is, I guess, a commandment of wealth would be that we're creating control around the money that we're growing, opposed to not having control.
I would say so. So again, commandment of wealth, for today is going to be control over no control, right? What gets measured gets managed. This is something that we talk to our clients about, and it's, again, you want to make sure that you have control over your money, because generally speaking, like, you know what's best for you and your business, right? I mean, I would trust myself with my money more than I would trust, the government with my money, if we're pertaining to, building my wealth, right? Right. Yeah, exactly.
Building your wealth instead of the CRA Canada or the government's wealth. Correct.
Yeah, exactly. So what we were talking about today was highlighting a strategy where, by using insurance and the unique set of rules that the CRA has for these insurance vehicles,
and playing within them,
completely legally, you are able to achieve so much more while still having control, right? So again, what's basically happened is the rules changed. The CRA and the government said, like, hey, this is how things are going to be now.
Yeah.
We're treating passive income like this, which basically means that people now have to pivot their approach. So the end goal might be the same for your money, but we're just taking a different pathway to get there.
We're pivoting, and you end up generating more control. So with that said, a commandment of wealth is control over no control. The article is going to be in the description.
Yes.
If you guys want to explore how this type of strategy can be unique to you and implemented under your name and your corporation, reach out, send us a message. Me and Alex would be happy to get in touch with you guys and go over how this strategy can help.
Absolutely. So thanks for tuning in. We'll have another episode out for you next week. And
till next time.
Till next year. Cheers.